Okay, we'll get going. Good afternoon, everybody, and you're welcome to this afternoon session. There's a few of you here. That's great to see. It's always good to have a few people listening to the sessions, and hopefully you'll all take something away from the talk and learn something new and bring it home to talk to your friends and family about. So my name is Mark Solon. I am the Managing Director of Symmetry Financial Management, and this afternoon session is the part one of two parts where we're going to talk about financial independence, what it means, how you go about it, is it achievable? If it is achievable, how do you achieve it? Is it a pipe dream? And everything that comes with financial independence. You can Google the term financial independence, and you are literally going to, and maybe just as an experiment, do it after we hang up. You will be bombarded with numerous websites showing you different ways about trying to achieve financial independence with different opinions. And there's even a movement out there called FIRE, which means financial independence, retire early. So again, I think it might take it a little bit to the extreme, but needless to say, it does exist. So I'm going to try and have this presentation done within the next half an hour, 40 minutes maximum. I don't think there's time or requirements for any more than that, but there is a chat function there. So I would encourage people, if they have questions, to put in the chat, your queries in there in a chat function, and just after putting a message in there, I'll try and keep my eye on it as we're going through the talk. So without further ado, just to give you a little bit of information about the company, if you haven't already listened into a webinar prior to today, we are an independent brokerage. We're based in Dunboyne in County Meath. We've been trading since 2018, so 3 years this June. The company was formed when I split from my previous company, where I was also a director and a shareholder. And in the previous entity, we were the mortgage broker of the year in 2017. So most of the staff came across here. So we know a thing or two about the financial world. Let's say there's 8 staff. Actually, we just hired another lady, started yesterday. So we are in a growth phase at the moment. So in relation to the topics that we've covered so far, so again, if you haven't listened in, I believe you can access the previous videos on the app. We have some of them up on our website as well. So I'd recommend you go back and listen to some of them. The content shouldn't be out of date yet. So we talked about how mortgages work. We talked about the mortgage process, what banks look for. We looked at investing in property. We looked at budgeting. We looked at money management. We looked at taxation. We talked about financial protection and risk insurance, and we talked about your credit history and the role that has to play in borrowing and any lending or borrowing arrangement you get into. So there's a lot in the talks we've done. The feedback has been superb. So again, appreciate all the feedback, and we encourage you to reach out to us. It's part of the package. So feel free to reach out to us with queries, questions, concerns, and take advantage of what our knowledge is or lack even thereof. So but yeah, we've got a good bit of expertise in the building in here. So in relation to what we're going to cover today, we're going to talk about financial independence. We're going to talk about the role of financial literacy when it comes to financial independence. What is financial literacy, basically? We're going to talk about a couple of the things then that are key to financial independence. And the first one is tracking your spending. So you saw we did a webinar specifically on budgeting and money management. So tracking your spending would have been a huge part of that. We're going to look at goal setting. So you have to have the goal in place if you are planning on thinking about financial independence as basically as part of your future. So that's really what it is. It's a way of living. It's a way of being. So it's not just a fly-by-night decision or a will I, won't I. It's a commitment. We're going to talk about savings and what's the different types of savings that are available. And so I'll be getting into much more detail on that over the next session. But the savings is really what helps you achieve the financial independence in whatever way you go about it. So talking about financial independence then. So what is it? It's basically having enough money to live enough income to pay your living expenses for the rest of your life. And that money is generated from assets that you've accumulated. Basically, it's not having a dependency or not being dependent on other individuals. So it's not being dependent. Again, if you go at this as a couple, so your husband and wife or a couple or partner, or if you're a single individual, then going about financial independence basically means that you want to be capable of looking after yourself, either completely on your own or as part of a unit. So, as I said, with a significant other. Equally so, not being dependent on others. We have an Asian financial division in here, and you do see it. It's quite common in different demographics. It's quite common, or different geographical regions. It's quite common for elderly individuals to be dependent on their children, on their family. So obviously, financial independence would mean that isn't something that is required. It also means being free of debt. Now, I have a caveat there. If the debt is associated with an income generating asset, and that income is greater than the debt, then debt is not a bad thing. So let me just explain that real quick. If I have 100,000 euros income coming in against assets, and those assets have €1 million worth of debt against them, so long as the cost of that €1 million isn't been eaten up by the 100,000 euros income, then there's excess income generated from those assets, and over time that €1 million will decrease, which should in theory increase the availability of the 100,000 euros again over time. So freedom from debt where excess income is not generated, that is important. Freedom to choose your work. So freedom to choose how you work, where you work, when you work, what you do, how often you do it. Having enough passive income. So the example I'm after giving you there in relation to rental income, for example, it could equally be government bonds, so coupons from government bonds. It could be dividend income from a share portfolio that you might have accumulated over time. So all of these things are passive income, and they're generated by accumulating the assets and or having enough capital to last. So that's basically where I've accumulated over time through investments and acquisitions and asset values. I now have X amount of million or hundreds of thousands, and that is sufficient for me to live on for the rest of my years, based on how much I need to spend on a day-to-day, week-to-week, month-to-month basis. Okay, so that's basically what financial independence is. It is important that it's an approach that you take to your living. It's an approach to how you treat your finances, how you treat your income coming into the household, literally from day to day, when you make the commitment. And it's important. It's like anything that we would have talked about in any of the sessions before. It's either a dream or it's a goal. And if it's a goal, then you make the decision and you go for it. That's pretty much as clear cut as I can make it. Okay. So why might you want to become financially independent? So again, you're kind of sitting there thinking, it sounds like it could be a bit of pain in that, Mark. So the whole idea behind it is you're financially free. So that's basically it. Now, I have put in brackets there or not, because I have a few high net worth clients, and half my time is spent educating them. So you might wonder how somebody can have accumulated substantial amounts of assets and not be financially free. And the answer to that is because they worry about their money. So they're not, in theory, they're not financially free. So we do quite a bit of work with these individuals, trying to get their mindset right. So because on anyone else's world, they would be extremely financially independent, but perhaps in their own world, they have this fear of losing what they've accumulated. So, and again, there's understanding and education involved and required there. Okay, I've already touched on the freedom to choose where you want to work, when you want to work, what you want to do. You know, a good piece of advice I was given many years ago is find something you like to do and get good at it and become good at it. And I found my way to financial services, and hence why I'm talking to you today. So sometimes if you find what you enjoy doing, that can also become part of your plan. That can be part of your financial independence plan, because it can become your business, for example. It can become your overall approach to what you're doing day in, day out, and hopefully enjoy what you're doing through the process. Okay, a lot of people work and do their jobs, but they don't necessarily enjoy what it is they're doing. They're doing it for the paycheck at the end of the month. And again, I'm not naive enough to think that, you know, everyone can follow what their dream is or do what they want to do. But in reality, if you make a go of whatever that is, if you make a go at it, then, you know, getting up in the morning sometimes can be a little bit easier. My staff are sick to the teeth hearing me talking about it. The other thing then it allows you to do is it gives you time to pursue your interests, maybe what you love doing. spending time with your family, spending time with your friends. So again, I use myself as a case study with some of this stuff. So I mean, our office is based in Dunboyne. The reason it's based in Dunboyne, outside of the fact that I live in Dunboyne, a lot of the staff that came from the previous company and that work for me live in the area. So we try and keep commuting out of it. Obviously, with current pandemic, that can be a little bit easier, but in reality, it's trying to keep the time people spend in cars to a minimum. Okay, so that's an example. I walk to work, so it's something that I always had wanted to be able to say I can walk to work, and obviously with COVID not needing my car for the last year, it's something that we've been able to achieve. I'll be walking home this evening to pick up my kids on the way home from the childminder, and they'll be walking home with me. So they think that's that kind of stuff, silly little things that you might say aren't important, but that's a goal. That's something you decide that you want to achieve, and then you say, okay, well, how does that look? What's required for that to happen? Obviously, we didn't plan to have COVID in our world, but you know, when it did come in, then you adapt to these things as they present themselves. So financial independence, it's a way. So again, what am I trying to get at? It's a way of being. So it's not necessarily about retirement, because people think retirement is financial independence. It isn't necessarily. And I'm after giving you an example of some of my high net worth clients. And these clients tend to be clients who are older in years, have accumulated their assets over their working career. And as I said, there is an element of fear there of losing what they have accumulated. So as I said, there's a huge education piece there. So there's a state of mind with regards to retirement, whereas financial independence is a way of being. It's a way of living. So that is really important. You map it out. What does it look like for you? It's going to be different for everybody. What's the number for you? It's going to be different from your brother, your sister. The number you choose could be different from your spouse. Okay, so just to kind of put it into real terms, it can be different for everybody, and it is different for everybody. Okay, so how do you go about it? So okay, we've talked about a little bit about what it looks like and the concept of financial independence. So what do you do to become financially independent? Well, you accumulate. So you basically gather enough assets that generate income, and that income is enough for you to live on. So it's more than is required for you to live on, and or cover expenses, your liability expenses. So for example, debt. So the example I gave you there, you already you have 100,000 euros income coming in, and you have €1 million worth of debt, but the 100,000 euros is still enough or more than enough to cover the cost of the €1 million. So there you have surplus income. Then the question is that surplus income enough to provide you with the standard of living you're accustomed to? Okay, so that's an example of generating assets, or assets generating income. You can accumulate liquid assets. So that's where over time you buy assets. So you buy stocks, you buy shares, you buy cryptocurrency. And the idea there is that at some stage in the future, you have accumulated enough. The value of that asset is enough for you to be able to live for the foreseeable future. Okay, so what does that mean? You need to know what the number is. So if I turn around to 99% of people and says, how much money do you think you're going to need to live financially independent for the rest of your life? Most of those people aren't going to have a Scooby-Doo. Never mind even stab a guess at it. They'll probably throw €1 million, €5 million, €2 million, but it's just picking a number out of their head. There is a way you can go about trying to identify what that number is. Okay. There's then the next step, which is where you combine that passive income and or the liquid assets, and then is that enough for you to achieve that financial independence threshold? So what is that requirement for you? Okay, you can go about it from reducing your expenses. So again, that kind of makes sense. It's basically reducing your regular expenses. Now, again, it's important. This is not necessarily about hoarding money. So I'm not advocating that you hoard money. In fact, I'm advocating that you use your money intelligently. So you'll often think of the individual in Ireland. We love using the term tight. He's tight or she's tight. Yeah, I'm from Leitrim. We used to always love. Hopefully, none of you are from Cavan, and if you are, you know I'm only slagging. But we used to always slag Cavan people in terms of their tightness. So this is not what we're talking about here. This is really about managing how you live, how you spend your money, accounting for your money, knowing where it's gone. And if you can't measure it, you can't improve it. Okay, so again, I didn't invent that phrase, but I certainly am going to use it. Then you have to move on to understanding the difference between the active and the passive income. So I'm okay, I'm on board. I understand what I'd have to do, financial independence. I know I have to get a number. How do I go about it? Then I have to identify how much I spend. But once you've gone through that, I'm going to come back to it in a minute, but once I've gone through that, then you have to understand how you go about generating this passive income. So Active income is what you're at today. So you're obviously on your lunch break or on your break, you're allowed to listen into the webinar, which is great. So, but you're being paid a wage for turning up at work. So that's basically an active. That's something you're doing. You're actively working. Or you're actively doing something to generate that salary. So it could be, you know, in brighter times, it could be that you're a part of a wedding band. So again, you're actively generating that income by going out on a Saturday night, playing as part of a band at a wedding, and you're generating income. So that's active income. Okay. What you should be doing is using that active income to purchase assets or invest in assets that help generate the passive income, because that's where the passive income comes from. The passive income comes from your active income resource or resources. Okay, so hopefully everyone follows that. So what is passive income then? Passive income is income generated from assets that when you're not working. Okay, so I'm going to give you a brilliant example. I got the money after going through a meeting with a young guy. He's originally from Brazil, went to Italy. He's actually moved into the property game with a company here in Ireland, and he bought a Deliveroo bike, a Deliveroo business. And the Deliveroo business, he was at it while he was working in this other company, but he's now moved up in terms of salary and in terms of responsibility, and he doesn't actually have time to be using the Deliveroo. So now he rents it to one of a colleague, a friend, or a friend of a friend, and he has income. Because I was going through his bank statements, we're applying for a mortgage. The chap has got a brilliant savings ethic, which I was commending him on, but he has passive income there from renting a Deliveroo bike. Okay, so it can be anything. It can be farming income. It can be forestry income. It can be investment income. It can be rental income. It can be government bonds, corporate bonds. It can be pension, obviously, if you're at that level. So anything that you're receiving into your account, anything that's earning you money when you're not actually working. Basically, you don't have to move for that to be generated. Might be a little bit of activity in terms of managing tenants if it's rent. It might be a little bit of activity in terms of managing your stock portfolio if it's dividends, making sure it's well diversified. Government bonds, it might be a little bit of activity there in managing maturity dates on the bonds, for example. But in reality, you're not getting up and spending the 40, 50 hours a week on passive income strategies. Okay. And depending on the income strategy, it can be tax advantageous. So there are many ways, and I would have touched on that in the tax talk, but there are many ways that generating passive income can be tax advantageous to you. Okay, so the beautiful TAX word, we all love it, and we all pay enough of it. And I'm listening to a lot of talk at the moment around the Irish corporation tax, and Janet Yellen from the Fed in the US talking about a global corporation tax rate of 20%, and thinking, okay, what does that do to Ireland? So we have a very favorable tax rate in Ireland, the corporation tax, which has probably benefited a number of your employers, people that you're listening on today, that that brought employment to Ireland, because we've got favorable tax regimes. So there's tax paid at all different levels by companies, individuals, companies, investment schemes, trusts, and it's just something you have to take into account when you are looking at putting these plans in place, and we do an awful lot of that with our clients. Okay, so moving on then, financial literacy. So what do I mean by when I talk about financial literacy? So skip through this. It's how money works, basically. So what's the process around money? What's the flows of money? Understanding the economics of money, understanding your financial resources, understanding your relationship with your financial resources. If you have excess, understanding how you invest it. So turn your money into more money while you're not working, you do have to invest it, and it just depends what that type of investment looks like. Okay, and the whole point of financial literacy is to educate yourself, to learn, with a view then to achieving the financial independence. Okay, there's many things that you do have to be aware of when it comes to financial literacy, and it's the biggest one, and I use this on any investment seminar or webinar I ever do. It's caveat emptor, and hopefully you've heard of that before, but it's basically buyer beware. Okay, so always ensure that you are aware of the risk that you are taking, if there's risk associated with your decision, which invariably there will be. So caveat emptor is like a wee friend there in the corner who's out in the storm without an umbrella, or he thinks he has, but he doesn't. It's making sure that you have informed yourself to the highest degree that you require. Okay, so that leads on then to your appetite for risk. So some people's appetite for risk is much greater or much less than others. So again, if I compared two families, so if you grew up in a family where your two parents were teachers, again, nothing against the teaching profession, or you grew up in a family where your two parents were entrepreneurs and ran their own businesses, more than likely your attitude to risk will be different than the individual who was brought up in the household with the two teachers or the two civil servants. Okay. And people tend to think as you get older, your appetite for risk changes as well. Again, there's arguments to be made where that's not necessarily correct. Okay. And it's your background. So were you brought up in an affluent family environment, a middle class income family where, investments and pensions and financial issues were talked about, on a regular basis, whether you were involved in the conversations or not? Or were you brought up in an environment where your family didn't necessarily know where the next meal was coming from? Okay, so those individuals will have vast differences, vast varying opinions when it comes to risk. And there's nothing saying that those two individuals couldn't be working side by side in the same company, having conversations around how to invest their pension money, or a share or a stock that their friend is looking at, or looking at a cryptocurrency or whatever it might be. The person with who's much more risk averse will take a completely different opinion than the individual that has a bigger appetite for risk. And it's just an understanding of that, what your relationship is with risk. Okay, and that's a really, really important thing. And the more you educate yourself, typically the greater the risk you're able to take. So risk is a fear, and the fear comes typically from not knowing or not knowing enough. Okay. What else is financial literacy? It's understanding debt. It's understanding the relationship of debt with interest rates, and it's understanding the relationship of debt, interest rates, and time. And if anyone isn't sure what I'm talking about there, go back and look at the mortgage webinars I did, where we talked about how you can beat the banks, how you can pay off that mortgage early, how you can be mortgage free and save not hundreds, not thousands, but literally tens of thousands of euros on your mortgage over a short to medium term time frame. Okay. It's also about saving and understanding the concept of saving, understanding the concept of compound interest, how you utilize or how you use compound interest, and most importantly, the role time has to play when it comes to all of this. So time is the most important thing when it comes to debt, and time is the most important thing when it comes to compound interest. So that's your value of your investments, the value of your savings increasing. Okay. And then the role tax plays. So I've talked about tax already, talking about it again. So if there is a clue in it, tax has a huge part to play in any financial plan. So any financial independence goals that you're going to be setting for yourself, you do need to include tax as part of that conversation. And there's many more other things that I could list there, and I'd be running out of slides if I was to put it all on the presentation, and you'd be bored listening. So, but needless to say, that's really what we're talking about when we're trying to get financial literacy across. So if you are astute then, and you're kind of saying, okay, well, where do I start? If financial literacy is this important, which it is, then you have to start with your view. So how do you approach money? So are you somebody that hoards money? Again, there's nothing wrong with hoarding money. Okay, you're amassing it. So then it's the goal. What are you doing that for? Where are you amassing it? How are you saving it? Okay, you have the other person that's maybe spendthrift. So I deal with more of those individuals than I would with the first individual. Okay, so are you an individual that its approach to money is, well, do you know what? Live for today because you don't know about tomorrow. There's an element of truth in that as well. But if you look at the CSO stats, we're all going to be looking at each other in our 80s and 90s. The way with medical advances, the way things have gone. So saving is okay, but in a managed environment. Then you have the individuals, loads of these. Oh goodness me! I had a meeting yesterday with a lady, self-employed individual, and was she the definition of a financial money avoider? She admitted it herself. By God, she was an avoider, and coming looking for a little bit of advice around retirement. So I sent her off with homework to do, which probably gave the poor woman cold sweats. But needless to say, avoider is a common trait out there. So my wife would be a part financial avoider because she depends on me, which is incorrect, and I'm always on to her about it. But she depends on me to look after a lot of the money issues. Okay, and then you have the investor, so the individual that understands that, do you know what, I have to put money aside here. I have to leave it to grow, and looks at opportunities, an element of speculation, an element of a risk taker there, not necessarily high risk. That individual could easily be a medium risk taker as well, but they're very much around thinking longer term. And that is where we're trying to always get people to transition towards. Okay, so when we engage our clients on this stuff, we're trying to get you to transition towards having that mindset. And how big of a mindset, how big of a position that takes in your approach to your finances will dictate how quickly you are financially independent. Okay. So why should you track your money? So what's this about? So, okay, Mark, you're talking about financial independence. Why are you talking about budgeting now? Because budgeting is the first step. So you can't become financially independent if you don't know how you spend your money. Okay. Managing your finances, knowing what you're spending your money on, is the most important thing that you can do. Okay. What else have I got to say about it? I don't actually. Budgeting is key. Okay, in all walks of life. Why is it important when it comes to financial independence? Because you have to be able to identify what the your financial independence number is. So I mean, that's probably isn't the right term for me to use, but it's basically, what is your number? How much money do you need to have accumulated by the time within the time frame you're setting yourself to be financially independent? And you can't know that without knowing how much you spend. Okay. So it really is important about tracking your finances, tracking your income via budgeting to take control of your finances. And equally so, and we get this all the time. So if you've been promoted, so I deal with people, again, very, very professional individuals, and they get promoted in their job, they get wage increases, they get bonuses. And what tends to happen is I've used it in the money budgeting seminar the last time. I used a case study of two clients, replica clients, where one was saving north of $5,000 a month, and the other ones we couldn't come up with affordability for the mortgage, and they were both earning the same levels of money, so it was significant incomes. And what had happened there was very simply what's called lifestyle creep. Okay, so lifestyle creep, if you haven't heard the phrase before, write it down and take it home and pin it to the wall, because what happens is you get your pay increase, you get your bonus in January or February, and your boss has just said, you're doing a great job, Mark, you're fantastic at your job, and we're going to give you a $5,000 pay increase. What do you end up doing with that $5,000 pay increase? You end up spending it. It just creeps into your lifestyle. You end up, instead of one takeaway a week, it becomes two takeaways. It obviously in COVID, you can't have the nights out, but you instead of looking at Amazon once a day, you look at Amazon twice a day. So the delivery men are flat out in this country. So lifestyle creep is an element of online shopping. So looking at, and again, we see this stuff on our mortgage business, where I'm looking down through bank statements, and it's Amazon this and Amazon that, and delivery here and delivery there, and Sports Direct and Next and Duns, and you name it, it is flat out. And same in my own house. So stuff arrives in the door. And to give you an example, I have a client who left the building trade, took on a Fastway franchise last year. Okay, last February. Talk about timing. Goodness me. Took on a Fastway franchise, one of the guys in the building trade, and they bought the franchise on the basis of 1,000 to 1,500 euros a week turnover. And he's been doing, on average, since last March, 3,500 euros a week in income for his franchise. Okay, so just to put to the extent that he's had to get another person involved. So lifestyle creep, it's probably the nights out and the weekends away, it's been replaced by online shopping. So just bearing that in mind. Again, there's no criticism here. It's just understanding what lifestyle creep is. Okay, so where do you start? You have to look back before you can look forward, and that's what a budget planner is. We've gone through this before. It's available on our website. We can send the link to you individually. In fact, we can even go through it. I charge 250 quid clients to go through an annual budget planner with them. I don't want to charge anybody a penny, because it's not something I want to do with people. It's something you should be doing yourself. It's very simple. All you do is you look back. How much money did I spend in March? There's an Excel, you fill in the bits. So income at the top and all the household expenses and miscellaneous expenses at the bottom. You don't guess it. You write in exactly the number that you spent, and it tells you at the bottom of the spreadsheet what the net or the surplus or the surplus or the deficit is for the month, and cumulatively. So we're in April now. So if you looked at your January, your February, and your March, and there was a deficit at the end of each month, you need to take a serious look at what's going into that Excel. Okay, so where you're spending the money, and if there's surplus, then the question is how much is the surplus, and then what are you doing with the surplus? Okay, and then you can decide looking forward. So then you can plan. So once I know how I spend my money, it's awareness. It's an acknowledgement of what I'm doing with my hard-earned cash. Then I can decide and plan into the future, which is the step 2 of budgeting. But if you only ever did looking back, do you know what happens? Looking forward actually takes care of itself, because you subconsciously are aware of how you've spent your money. Don't cringe at it. It is an absolutely, Dylan in fairness has just stuck it up. It is absolutely imperative that you do take on the budgeting as the first task. If this is something you're listening in today, and this is something you want to take a stab at over the coming weeks, months, and years. Okay. I'm going to just skip through this just for the purposes of time, but when it does come to your financial independence, you have to look at what stage you're at. So, I mean, I was going through this with my staff this morning. I've got staff at almost every stage. So I've staff who are young and free within the COVID environment, obviously, and single. So, their goals and their calls and their capital is totally different than the individuals who've just got married and just bought their first house. Completely different than, if you've got the young family. So kids going to school, you've got education costs down the line. So that's the full nest concept. And then you've got moving into the retirement. So you're planning for the medium to long term. So that's the key. They're the key stages to the financial plan. And all you're basically trying to see is, by becoming financially independent, that you have the income to cover all of these stages at within a particular time frame. So there's nothing saying that you cannot be financially independent at that stage. There is only a decision that has to be made. If you're back here, you can easily achieve financial independence at this stage, not necessarily waiting at this stage. Whereas if you start the plan here or here, then you might be at the tail end of stage 3, let's say, or if you started at the full nest stage, you're going to look at retirement, albeit it could be an early retirement time frame, to achieve the financial independence. And again, I was going through this with a couple of my staff yesterday when I was showing them the slides, and one of the staff is 15 years younger than me, and explaining to him that what he could achieve in the 15 years, so that when he was the same age as myself, what it would be potentially achievable to him. And I'm looking back 15 years ago, it just seems like yesterday. And he's looking forward, thinking, Jesus, that seems like years and years and years away. So it's just a mindset, a shift of a change in your mindset is all that's required to go after this. So when it comes into financial independence, what are the foundations? It's just getting going, guys. It's just not thinking about it too much. So be roughly right, not precisely wrong. So what I mean by that, just take feckin' action. So have a plan in place. So and the plan is going to change. It doesn't have to be something you carve out in stone or you cement into your tattoo onto your arm, or whatever analogy I want to use. It's just having a plan and having the plan to be flexible. Avoid excess debt. So don't take on too much debt. Managing credit cards. Again, give you so many examples in this crack, guys, if I had the time. A lady yesterday looking for a mortgage. We were able to structure the mortgage in her own name, not including the husband. And I was going down through the paperwork she had to get, and what loans and what debt she had. And in her mind, she said, "No, no loans, right?" And then conversation with her, I says, "Actually, no, I have a credit card." Okay, so then she had a credit card. No, I have another credit card. She says, "Another credit card." Turns out she has 2 credit cards. She has what she's calling an equity loan with her brother that she took out years ago on a house in Cork. She had a mortgage with her husband, but because he paid the mortgage, she didn't think she was on the mortgage. And then she was on a mortgage with her brother, and again, because he paid the mortgage, she didn't think she was on the mortgage. So it's madness, but there's mad examples and mad stories out there. We get them every day of the week. So it's understanding the role debt plays. Okay, and that lady, the conversation when I went through the information with her, was like, there's no chance of her taking on any more debt. Okay, so avoid excessive debt, but debt used in the right way. The flip of that is, I have a very, very good client of mine, investment client and a developer client. He's in his mid-30s, and he's went off to Spain to avoid the whole lockdown in Ireland. And why is he achieving that? Because he's got enough passive income coming from his property portfolio. Okay. And he didn't do anything that couldn't be achieved by the majority of us. He just worked hard and did it right. Okay. You spend less than you take in. Okay. So putting money aside, have an emergency fund. So setting a few quid aside so that you do have an emergency fund, and then everything else works for you. Okay. If you have a mortgage, look at the webinars we've done before, or talk to us about it on a one-on-one about how you can pay off that mortgage early. Again, we can tell you the tips and tricks, what to do with what bank and how to go about it. I strongly attest to the paying off your home early, because I do it myself. Okay, so I have a plan to be mortgage free within the next 7 to 8 years, which is an aggressive target, but on track for it. Okay, and then invest the difference. So make sure the rest of it is working for you, whether that's savings, whether that's pensions, or a combination of asset purchases. So what do you have to do? If you do want to become financially independent, you do have to invest. So there's no way around this. It's not like, do I have to, should I not? You have to. So if it's not for you, if investing isn't for you, then financial independence is not something that you're going to be able to achieve now nor in the future, to be honest with you. So you're always going to be living with the what ifs. You're always going to be living depending on somebody else, whether that's inheritance from family, or whether that is the state pension age at 68, which, if we go through another rough patch in the future, they decide to cut 25% off it, which is what they did in the past, or not index it up in line with inflation, which in reality is what's been going on over the last 10 years. So you're depending on something that you have no control over. In terms of how you invest, stock market is probably the best way to compound your money over time. Okay, so it's very hard to argue against the stock market. Again, there's good and there's bad, and that is where you educate yourself, or you look to the right people to give you the advice. It always goes up in the long term. So there's no argument with this. So since it's existed, the stock market has always gone up in the long term. That doesn't mean that it's not going to come down. Of course it's going to come down, and by Jesus, when it comes down, it drops, and it drops like a stone, right? You don't know about it going up. Why do you not know about it going up? Because the papers don't write about, the stock market's up 25% this week, or the Dow Jones is hitting an all-time high, or the S&P is an all-time high, or the FTSE, or the ISEC, or whatever it is that you're investing in, they're at all-time highs, which they are at the moment, by the way. Okay, what you will hear about is the S&P is down 10%. Why? Because that makes news. That's feeding the fear. That's putting people off the whole concept of the stock market. Whereas in reality, the S&P 500 is probably heading towards 8,000 points in the next 5 to 10 years, where it's over 4,000 points at the moment. And this time last year, when COVID hit, it dropped to in and around 2,000 points. So it's up approximately 100% in the last 12-month period, but a lot of volatility in it. So if you look at the stock market in that small window, then it probably scared the pants of most people. Whereas if you look at it over a medium to longer term, then it should take an element of the fear off. And we spend a lot of time educating on that and explaining how it works. None of us are smart enough. I mean, I've got investors who try to time the market. It's an impossible thing to do. You can get lucky, absolutely, and I'll put my hand in the heart, and I've been lucky myself. Okay, so where you can time the market and you buy an asset, and the asset goes up more than you were expecting it to go up. Okay, but that's pure and utter luck. Okay, so trying to time the market is a hard thing to do. It's just about getting involved, getting started, and giving it time after that. Okay. Property is another fantastic income generator, and I gave you the example of my client who's currently sunning himself in Spain. It's mainly an income generator, and if you're coming to us and you're looking for advice in the property space, we will always look at it as an income generator, and we'll always calculate the capital appreciation at a very, very, very low figure. In fact, if anything, at a zero figure, just to keep things conservative, and always focus in on the income generator. And again, stressing that as well to make sure that things still look positive. Okay, so property is a lovely way to generate an income, and then educating yourself to look after this stuff. I'm not necessarily telling you have to do it all yourself. Obviously, if people did it all themselves, companies like us wouldn't exist. But it's finding a company where you have that relationship. There's an element of trust, and educating yourself that you know as much about your money as you possibly can. Okay. Why am I putting that one in there? Because compound interest is that important. Okay, it works for you, or it doesn't. So you earn it, or you pay for it. Okay, so it's either or. And equally so, why am I putting this in? Because this is saying, or this proverb in, because it's just about taking action. So it's very simply about saying, yeah, okay, I don't have an exact plan in place, but I'm just going to go for it now. Okay. So how you save then finally is just to save. Okay, so just getting started with saving, number one. The problem with saving, obviously, is with the credit unions and the banks, is there's no money to be made on. So you do have to look further afield. You do have to look at the concept of compound interest, getting that money working for you, and whatever that looks like, and whatever method that is, diversifying. So if that's in relation to buying stocks or shares with the likes of the Giro website. So again, we can advise you on all this stuff as and when you want it, but if it's buying a portfolio of stocks and shares, you diversify it and you do it regularly. So as opposed to taking 10 grand and putting the 10,000 euros in, you invest it over an average period of time, which I'm going to just talk about at the very end here. And then you have the different approaches. You have the active management and you have the passive management. It depends on your personality there, which is right for you. It depends on the time frames, how much time you have. It depends on, what your risk appetite is. Okay. So there's an awful lot of things will come into the mix to identify the difference between active management and passive management. But to put the investing regularly into context, there's me and there's you. I'm investing 3,500 euros. You're investing 3,500 euros. I invest it all on day one. Why? Because I can't be arsed with having to do something on a monthly basis. So I buy 125 units of Microsoft shares at €4 a share. We wish. But anyway, I'm buying 125 units of share X. So that's me 3,500 gone in. You decide you want to buy the same share, but you want to buy it over the next 7 months. So you spend 500 quid a month instead of 3.5 grand at the outset. So at the end of 7 months, we're both sitting having a cup of tea, and we're looking at each other's portfolio. How many shares have you accumulated? Well, you've accumulated 1,132 because you bought them over the 7 months, and there was ups and downs in the share price over that 7-month period. Whereas I bought 875 at the outset. Now, if the share price is still at $4 or €4 a share, your price hasn't gone up. Where I've got them at €4 a share, so the value of my investment is over 4,000 euros. So almost 4,500 euros, actually over 4,500 euros. So the value of my investment, just in that very, very small window of an example there. It doesn't always work, by the way, because you could invest in something like a Tesla and put your money into Tesla, and Tesla just goes up, whoosh, shoots up at a rate of knots like it has done over the last 12 months. And if you were buying on the drip over that 8-month period, then you would have just been buying less units every month on month. But that's just in the 8-month window. God knows what Tesla will do in the future. And if you had been buying it for more than the last 8 months, then you would have done extremely well. But it's just to give you the concept, in that window of 8 months, which I'm showing you there, it can work against you. But typically over time, it works for you. It does work. It's a way to do it. It's how you accumulate wealth without taking a lot of stress out of it. And to put a number on it then, so the same concept, 8-month cycle in this case, I invest $8,000 at the outset. You invest $1,000 a month. Same concept. We're buying into a share. The day we start, it's about $10. It fluctuates up as high as 14 and as low as 7.5 because it's a volatile product. At the end of the 8 months, the investment is back at the $10 a share. I'm still at zero in terms of my return, but you're not. You're up 4% because you availed of averaging. So this is called unit price averaging, dollar price averaging, euro cost averaging, unit price averaging, what term you want to use for it. But it's basically where you diversify, you spread your risk over time, and you can diversify it in different assets. So imagine the power then of diversification. You're doing it over time and you're doing it over other asset classes, how it can work to your advantage. Okay. So the benefits of it are, you control how much you invest on the time horizon. You don't need to time the market, which we already discussed is very, very hard thing to do. You can start small and then build up if it's working for you. And even if it's not working for you, still start small. There's an investor in America, and he's got a model where he basically encourages his clients to invest $5 a day into 5 different asset classes every day. And you can set up with a particular stockbroker in the US, you can set it up that it takes $5 a day out of your current account. Not as sophisticated over this side of the pond, but it doesn't mean that you do it daily. You could do it monthly. Okay. And the same principles will apply. Okay. And then how that accumulates over a time frame to increase your asset values and your wealth. It takes the emotion out of investing, which, let's be honest with you, is the hardest place to start. Okay? So then finally, what are the myths? We're finishing up. What are the myths? Debt is unavoidable. You can avoid debt. Okay. Is it a bad thing? It's not a bad thing, by the way, if you do it right. So there's two contradictory topics, because it's all about how you look at debt. It's all about how you use debt. So you use it or it uses you. So the Einstein quote there about compound and interest, the exact same rule applies for debt, in particular long-term debt, in that the interest is compounded in reverse. So you pay more interest earlier, less later. So if you know that and you use that to your advantage, then you can be debt-free an awful lot faster and use that debt to your advantage. You have to be rich to invest. Again, it's codswallop. I'm after putting that myth to bed there. The stock market is complex. Again, hopefully I've put that to bed there. You don't earn enough to save. Budget is the answer there. You start saving for retirement later. You start now. You start straight away if you haven't already started it. Do not pass go. Do not collect your next paycheck without setting your retirement in place. And if you have it in place, look at maxing it out. How much money can I set into my retirement plan? And again, hopefully the company you deal with have advisors. I know it can be hard with some of these trustee companies that don't seem to care about their staff or their clients. They're there for the trusteeship. But if you are looking at retirement, get advice in relation to the fund choice you have available to you. Speculate a little bit with regards to your assets. Don't always take the structure that's been presented to you, because sometimes the structures that are there, you can go into a passively managed S&P tracking index as opposed to some managed fund being provided to you by Irish Life. Okay. So what other foundations are there? Income is wealth. Again, hopefully I've given examples there where that isn't always the case. So just because you earn more does not mean you're wealthy. It's how you manage that money. It's how you utilize that money, how you get that money working for you. So you think about your euros in terms of, are they sweating for you? So are you putting your euros to work, or are they sitting there on their big fat couch doing nothing for you? Okay, there's my alarm. Buying is better than renting. I would probably say long term, yes. In the current environment, there's an argument to be made. It's a bit mental out there in terms of the property market. Keeping track of your money, so you don't need to budget. You cannot keep track of your money if you don't budget. So this is looking at your phone, looking at your app, looking at Revolut is not tracking your money. It's not budgeting. Yeah, you're looking at it for this month, but you haven't a Scooby-Doo what you did in January. No way you can. Okay, and I've been around the block on this one too long. You have a partner that looks after things. You don't need to worry about it. And then the professionals. We love the professionals. We are professionals ourselves. Professionals have your best interests at heart. So anyone that was listening to the news over the last couple of weeks will know our friends in Davy certainly had their clients' interests at heart. It's been buried completely. The story has been buried completely. But there's a lot of weeds to be pulled in relation to that story yet. And you just have to be wild careful who you're dealing with and what they're telling you. Okay, so what are we going to talk about next week then? I'm going to give you a few case studies, but I try to do that throughout the presentation so you have real life examples of what we're talking about. We're going to have a little look at cryptocurrency. We're no experts on cryptocurrency, but I have got my staff involved in it because, in terms of putting money into it, I think if you miss the boat, it's like if you miss the opportunity, you're going to be looking back in 10 years' time saying, Christ, what was I thinking? And again, there's good and bad with cryptocurrency. We're not experts on it. We're not a cryptocurrency firm, but we tend to talk about what we do ourselves. And this is something that I will talk about a little bit next week or the week after next. I'm going to talk about how assets grow, what's involved in asset growth, time frames, so the different time frames, and then this 4% rule. So what is the 4% rule, or is it a 3% rule, depending on what you read, and talk a little bit around that and its role in the financial independence space. Okay, and then lastly, I'm pitching a smart money seminar that we're doing at the end of the month. So Wednesday the 28th and Thursday the 29th of April, evening sessions. So it's in the evening, so it's not going to interfere with your day. So in case there's any HR listening in, it's 5:30, 7:45. The 2 evenings at the end of the month. We've got speakers coming in from the US. We've got a guy called Morgan Housel. He's written a book called The Psychology of Money. It is a fantastic read, absolutely fabulous. New York Times bestseller. I'm going to be interviewing him. But anyway, there's tickets on sale. It's a online seminar series. Peter Brown from Baggett Investments going to be talking. Cody Sanchez, again, investment guru from the States. Andrew Craig and yours truly will be doing a little talk as well. So we're going to be bombarding you and educating you with all things financial for 2 evenings at the end of the month. The link is in the presentation there. I'd encourage you to register, and hopefully see some of you inside at the webinars on the 28th and 29th. Okay, so if you want to follow up with us, go to our website, symmetryfinancial.ie, or email us info@symmetryfinancial. Book a consultation. There's to be honest with you, there's 2 or 3 ways you can get in touch with us now and organize a presentation or organize a consultation. And again, it is complimentary, as we've said to you throughout all these webinars. Okay, so any questions coming in? When it comes to budget tracker and pension, do you want for the ones taken from your salary? Of course you do, absolutely, Charlotte. So ideally to come from your salary, because if they come from your salary, then you don't even have to think about it. Now, the only thing typically that's going to come from your salary, unless you're employed in the public sector, the only thing you're going to be able to account for is your pension. Most employers don't have facilities in place for saving schemes and or for, you know, credit union accounts or anything like that through your website or through your payroll. Now, what you do have is share purchase schemes. And again, my mind boggles when I see clients who work for Microsoft or Workday or the list is PayPal or eBay or any of these clients that we're dealing with, LinkedIn, where you have the option to buy shares and you've accumulated these shares, and then you see people selling the shares. Okay, so if you're selling the shares, then it's important that you're, you know, do you believe in the company you work for? Okay, so if you believe in the company you work for, then you should be accumulating the shares. Now, I wouldn't be saying put all your money into it, but the tax efficiencies of acquiring shares, either through RSUs or through the ESPP schemes, it is advantageous. Okay, so it is a nice way to get you started in what we're after going through. Okay, and Charlotte, my pension goes trying to get my net salary when I'm I didn't just have a budget tracker. What no, you don't. So you don't include it on the. So you're asking in relation to budgeting there, Charlotte. Sorry, it was a private message came through there. So Charlotte's question was, do you account for the pension contribution? No, if it's taken out of your payroll, what goes on the budget planner is the net figure on your payroll, and then there's a pension tab on the Excel. You don't put anything in there because it's already taken out of your payslip. Okay, just check how much you're paying in. Can you increase it? Is there advantages to increasing it? Will your employer match more? Again, but as I even say to my own staff, instead of coming looking for a pay increase, come looking to me to put more money into your pension. Okay. That's the questions. I don't see any more, so hopefully it was clear. So if there's not that many questions, then I'm going to wrap it up. And if you do have an inquiry or desire to contact us, reach out to us there directly, and we'd be happy to help you in any way we can. And other than that, I'll bid you adieu, and I'll look forward to talking to you again in 2 weeks' time with session number 2. Thank you very much.